Hello, friends. Welcome back to the channel. I hope you're ready to supercharge your trading journey today. If you've ever felt stuck watching charts all day long, stressed, and second-guessing every move, then today's book is going to be a game changer for you. We're diving into The 1 Hour Trade by Brian P. Anderson, a practical guide that proves you don't need to spend countless hours at your screen to be a consistently profitable trader. And here's a quick note. I'm not exploring every single chapter in full detail. Instead, I've handpicked some of the best lessons from the whole book so you get the most powerful insights in one place. Anderson's method is simple but powerful. Trade only during the first hour when volume is strongest. Follow proven checklists, control your risk like a pro, and spend the rest of your day living your life. In this video, I'll break down each lesson in clear, easy language. So even if you're a beginner, you'll understand exactly how to apply it in your own trading. So make sure you watch till the end. Hit that like button if you find value. Share this video with your trading buddies, and don't forget to subscribe to the channel for more trading wisdom that saves you time and money. All right, let's unlock the power of the 1 hour trade and build a trading routine that works for you, not against you. Let's get started. Lesson 1. The 1 hour trade concept. Imagine waking up each morning with a plan so simple, yet powerful enough to change how you see trading forever. The 1 hour trade is not about chasing price all day, watching random charts, or sitting stuck to your screen until your eyes burn out. It's about discipline, focus, and freedom. Brian P. Anderson shows that the market's most decisive moves usually happen during the first 60 minutes after the opening bell rings. This short window is where the largest number of traders, funds, and algorithms interact, driving sharp price swings and creating clear patterns that repeat day after day. Instead of being chained to unpredictable moves throughout the whole day, you only need to master 1 hour and a single proven setup. This mindset breaks the myth that profit needs endless watching and guessing. Many traders lose because they feel forced to make something happen in dull hours, leading to overtrading and careless mistakes. Here, that stress disappears. With 1 hour of pure intention, you avoid emotional fatigue, boredom trades, and the temptations of forcing bad positions. Anderson insists that this approach suits any trader who wants consistent results without letting trading consume every waking minute. The goal is not just to make money, but to protect mental energy for the rest of life, family, hobbies, or even another job. He believes that trading should fit your life, not the other way around. This means when the first hour is done, you shut the computer, walk away, and trust the process. No revenge trades, no second guessing. Discipline is the secret sauce that holds it all together. How does it work in practice? Start each morning fully prepared. Use a scanner or a simple news check to find stocks with unusual pre-market action or big overnight news. These are the candidates likely to surge or drop as soon as the market opens. Focus only on high-volume movers. They tend to respect patterns more predictably than low-volume traps. Have your watch list ready before the bell rings. Once the market opens, stick to your plan. Wait for a clean signal. Take the trade, manage risk, and don't hold it longer than you should. Anderson's philosophy is clear. Small, repeatable wins compound over time and beat random big bets that rarely work out. He warns against the rookie mindset of dreaming about catching every pip or tick all day long. The truth is, more trades often mean more mistakes, more fees, and more emotional stress. By narrowing your focus, you reduce bad habits and learn to trust just one edge, the high probability moves right when the market is most alive. This strategy also helps develop confidence. When you see the same pattern playing out daily in that first hour, it becomes familiar territory. You begin to trust your skills, your plan, and your discipline. This reduces hesitation and the urge to break your own rules. Over time, this habit frees your mind from second-guessing and endless chart watching. Another hidden benefit is how this shapes your life outside trading. You gain back hours that can be spent learning, resting, or living. Many traders burn out fast because they sacrifice everything else chasing constant action. The 1 hour trade restores balance and keeps trading exciting yet controlled. The mindset is simple. Treat trading as a business, not a casino. Show up each morning with calm focus. Take the trade when conditions are right. Protect your capital. Lock in profit when the plan says so. and walk away proud, win or lose. No more wasting precious hours hoping for miracles in dull market hours. Lesson 2. Identifying high-volume runners. Every winning trade starts with picking the right stock. Without the right candidate, even the best strategy falls apart. Brian P. Anderson explains that the real secret behind the 1-hour trade is not just the pattern or timing, but also choosing a stock that has the power to move big and fast. These are called high-volume runners. They show clear signs before the market opens if you know where to look. Each morning, start by scanning the pre-market for stocks that are gapping up or down significantly compared to their previous day's close. These gaps usually signal news or events powerful enough to attract traders' attention in droves. When traders pile in, volume spikes and price moves cleanly. This is exactly the kind of setup that makes the 1-hour trade so reliable. Anderson recommends simple tools. You don't need expensive software. Free stock scanners online can filter stocks by biggest pre-market percentage change and highest relative volume. Check financial news headlines too. Earnings reports, FDA approvals, mergers, lawsuits, or analyst upgrades can trigger sudden interest. Once you spot a stock with a decent gap and big volume, dig deeper. Look at the float size. That's how many shares are available for trading. Stocks with a lower float tend to move more aggressively because fewer shares create bigger price swings when demand spikes. A giant float can slow movement and dull volatility. Anderson's sweet spot is a float size that's not too tiny to be manipulated, but small enough to run sharply when volume pours in. Next, check the pre-market chart. Look for clean trends or clear levels. Is the price building higher on strong pre-market trades? Or is it choppy, back and forth with no clear direction? A clean, steady climb often suggests real interest, while erratic jumps can mean fake hype or hidden traps. Ignore stocks with no clear flow. The goal is to trade only genuine momentum, not random noise. Building a watch list should not take hours. Limit yourself to 3 to 5 solid picks. More than that invites confusion and split focus. Each candidate must have a good gap, big volume, a manageable float, and an obvious catalyst. This habit saves time and keeps you calm when the bell rings. You won't waste precious minutes flipping through dozens of charts. You'll already know which few deserve your attention. Another key tip: check for overlapping big events like earnings calls or press conferences scheduled during the first trading hour. These can fuel unexpected moves or reversals. Always factor in timing. If possible, check if the stock has run in similar past situations. Patterns often repeat. Strong earnings beats tend to spike early and fade later as the news impact wears off. Anderson warns strongly against random picks based on chat rooms or social media hype. Traders lose money chasing rumors or jumping on crowded plays too late. Let your scanner and newsfeed filter reality from noise. A high-volume runner chosen with logic and facts beats any tip from a forum. This entire preparation stage is the backbone of your 1-hour trade. Without a quality pick, even perfect timing won't help. Good traders become experts at spotting the signs of a true runner and ignoring distractions. This skill alone separates consistent winners from frustrated beginners. When the opening bell rings, you'll have total clarity. No panic, no fear of missing out. You'll watch your shortlist, wait for your setup, take your shot, manage your risk, and walk away with calm confidence. Proper stock selection is what turns this method from an idea into a repeatable system. Lesson 3, the red flag checklist. Smart trading is not just about spotting great opportunities. It's equally about dodging the traps that quietly drain your money and your confidence. Brian P. Anderson calls these traps red flags. They're the silent warning signs that shout, "Stay away. This trade will cost you more than it will ever give you." Learning to see them early is how traders protect their accounts and their sanity. One major red flag is low volume. A stock might look attractive on a chart, but if hardly anyone is trading it, price moves can be fake and unpredictable. Without volume, price jumps can reverse in a heartbeat, and you may find yourself stuck with a position you can't exit without giving up a big chunk in losses. High relative volume is the lifeblood of a valid trade. Lack of it is a classic trap. Another clear warning is a messy, choppy pre-market chart. Smooth, clean trends show control. Someone with size and purpose is moving that stock. But when a stock jumps up, drops down, then zigzags for no reason, it signals confusion and lack of commitment from traders. Entering on such noise often means battling sudden reversals and random fake breakouts. Anderson's advice: skip it. Wait for structure, not chaos. A wide bid-ask spread is just as dangerous. A tight spread means you get fair entry and exit prices. But when the spread is big, it eats into your profit instantly. Even if you're right about direction, that gap can turn a winning trade into a scratch or a frustrating small loss. Before clicking buy, always glance at the spread, a quick habit that saves money over hundreds of trades. Then there's manipulation risk. Some stocks, especially low-float tickers, attract pump-and-dump schemes and chat room hype. They can look explosive, but are often driven by coordinated manipulation rather than genuine investor interest. Volume might spike suddenly, but the move rarely holds once the hype fades. Many new traders get caught in these pumps and sell in panic when the price collapses. Anderson teaches that discipline means knowing when a stock is too risky to touch, no matter how tempting it looks. This checklist of red flags isn't optional. It's your daily defense. Many beginners obsess about hunting the next big winner, but forget that the easiest way to grow an account is to stop bleeding money into bad setups. Trading selectively is not missing out. It's sharpening your edge. Before every trade, run a mental check. Is the volume strong enough? Does the chart show a clear pre-market trend or just wild noise? How tight is the spread? Could this be a target for manipulators? If any answer raises doubt, skip it. No single trade is worth gambling your hard-earned money. Anderson reminds traders to treat capital like a soldier on a battlefield. Protect each dollar fiercely. Money lost on a bad trade does more damage than you might feel in that moment. It weakens your confidence, tempts revenge trades, and pulls your focus away from quality setups. By screening out weak trades with the red flag checklist, you keep your mental energy intact for real opportunities. Some days, you'll find more red flags than green. That's not failure. That's smart risk control. Many traders lose simply because they force trades on days when the market offers nothing clean. Staring at a chart doesn't make it safer. Patience does. It's better to wait one day and trade tomorrow than to jump into a mess out of boredom today. Over time, this habit trains your mind to spot danger instantly. You develop an inner filter that catches traps before you even consciously name them. It becomes automatic. Fewer bad trades mean less frustration and steadier growth. The core lesson is simple but powerful. While finding the perfect setup feels exciting, avoiding the bad ones is where real survival happens. Respect your rules, protect your money, and trust that true opportunities will appear for those patient enough to wait. Trade with courage, but guard your capital like a treasure chest. This mindset keeps you in the game long enough to win it. A winning trade doesn't happen by chance. It's the result of spotting clear signals that say, yes, this is the right moment. Brian P. Anderson calls these signals green flags. They are the proven conditions that separate high-probability trades from risky guesses. Understanding them transforms an ordinary trader into someone who knows exactly when to strike and when to step back. First, high relative volume is the heartbeat of a strong trade. Volume tells you how many people are involved and how serious they are. When a stock trades with 2, 3, or even 10 times its usual volume, it shows real interest. More traders mean cleaner trends and faster moves. Without volume, price can drift aimlessly and fake you out. So, check relative volume every morning. If it's flat, move on. Next, look for a strong news catalyst. This is the fuel behind the volume. Earnings beats, surprise contracts, FDA approvals, or even unexpected downgrades can push prices far in a short time. A stock with no fresh reason to move might attract random volume for a moment, but often fades quickly. Real news locks in real momentum. This combination of big volume and powerful catalyst forms the core of the green flag approach. A clear trend is equally important. Anderson urges traders to study the pre-market chart and the first few minutes after the bell. Is the price respecting levels and moving steadily in one direction, or is it spiking wildly and crashing back? Smooth moves mean serious buyers or sellers are in control. Choppy action means confusion, a danger zone for new traders. Wait for clear direction, then ride it with discipline. Another sign of a healthy setup is a tight bid-ask spread. This detail might sound minor, but it can save real money. A wide spread eats your profits with slippage and can turn a winning exit into a frustrating loss. High volume stocks often have tighter spreads because more traders compete to buy and sell, squeezing the difference. Always check this before clicking buy. Anderson's checklist isn't just theory, it's a daily ritual. Before every trade, mentally tick each green flag. Big relative volume? Check. Solid news catalyst? Check. Clean trend direction? Check. Tight spread? Check. If any piece is missing, be honest with yourself. Sometimes the best trade is the one you skip because it isn't past the checklist. This habit of scanning for green flags sharpens your judgment. Over time, you trust your eyes and instincts more because they're backed by real proof. New traders often jump in too soon, excited by any sudden candle. The checklist slows you down just enough to confirm the odds are truly in your favor. Combined with the red flags, the warning signs that tell you when to stay out, the green flag checklist acts like a trusted gatekeeper. It gives you confidence that your risk is logical, not emotional. It's the science behind your plan. Anderson reminds traders that discipline and consistency beat emotion every time. This is how pros survive and grow accounts while amateurs burn theirs out chasing hype. This approach turns every trade into a repeatable business decision, not a random gamble. You don't need to guess or hope. You follow the same filter daily until it's second nature. Once this habit locks in, your mistakes drop, your stress fades, and your focus sharpens. Green flags keep you grounded when the market throws distractions your way. News squawks, rumors, and chat room noise lose their power when you have a proven personal checklist that says, ignore the noise, trade the signal. This lesson is not just about picking good trades. It's about protecting your money and your confidence. The real secret? Be patient enough to wait for multiple green flags to line up. Some days, there might be none. That's fine. Walk away and protect your capital. Good traders know that missing a bad trade is as valuable as taking a good one. Trust the checklist, repeat it daily, and let it guide you through the noise to consistent, calm profits. Lesson 5, the multi-time frame chart setup. Successful trading isn't just about catching a quick move. It's about seeing every angle before committing your money. Brian P. Anderson teaches that one of the biggest mistakes traders make is staring only at the intraday chart while ignoring the larger landscape. This is why trades fail unexpectedly. Hidden support or resistance on bigger timeframes shows up and flips the market against you. The solution is simple yet powerful. Always check 3 timeframes before taking any position. Start with the weekly chart. This view reveals the strongest, longest-lasting support and resistance zones. These levels hold weight because they're built on years of price action. Institutions, hedge funds, and big money respect these zones. When price approaches them, reversals often happen. Mark these areas first. They act like guardrails for your trade plan. Next, drop down to the daily chart. This window refines your context. Here, you confirm whether the stock is trending up, trending down, or stuck in a range. Daily charts show obvious gaps that could act as magnets or roadblocks for price. A stock gapping above yesterday's high on big news, for example, often has more room to run. Conversely, if it's about to hit a strong daily resistance, be cautious. The daily view bridges the gap between the broad weekly perspective and the rapid-fire intraday action. Finally, look at the intraday chart, the 1-minute or 5-minute time frame. This is where precise entries and exits happen. This chart shows the immediate battle between buyers and sellers, revealing breakout points and pullbacks. While the weekly and daily charts guide your plan, the intraday chart tells you exactly when to pull the trigger. Watch how price reacts near your marked levels. Strong rejections or clean breakouts confirm what the higher timeframes hinted at. Combining these 3 charts doesn't take hours. Once practiced, this scan can be done in minutes. It's not about adding complexity, but stacking the odds in your favor. Most failed trades come from surprises. Price suddenly stalls or reverses at a level you never saw coming because you didn't zoom out. Anderson reminds traders that charts don't lie. They show every clue openly to those disciplined enough to check them. This habit also builds confidence. Knowing where major obstacles and clear paths lie frees your mind from guessing. If the weekly and daily trends align, the intraday setup gains strength. If they conflict, You instantly know risk is higher. This awareness prevents jumping into trades blindly or holding losing trades out of hope. Multi-time frame analysis also helps with setting realistic profit targets and stop-loss levels. If a stock is climbing towards a strong weekly resistance just above your entry, don't expect it to blow through easily. Book profits near that level or tighten stops. Likewise, if you see no major hurdles ahead on any time frame, give your trade more room to breathe and capture a bigger piece of the move. Anderson emphasizes never to skip this triple check. Traders who trust only one chart trade half blind. A 5-minute candle can look strong in isolation, but could be crashing straight into a fortress on the daily chart. Avoiding this trap separates prepared traders from impulsive gamblers. This approach turns a simple trade into a calculated, high-probability move. It's a blend of awareness and precision. You're not chasing quick wins. You're building positions based on real evidence across timeframes. This habit removes panic and second-guessing because your plan stands on solid ground. Anderson's message is crystal clear. Charts never lie. Price leaves footprints at every level. Those who study them calmly, on every scale, trade with confidence and control. There's no magic, just discipline to see the bigger picture and the patience to wait for the right moment. Respect the story each time frame tells and align them to unlock the smoothest trades. Lesson 6, Entry and Exit Rules. Great trades come from great timing. Not just guessing when a stock might move, but knowing exactly when to pull the trigger and when to walk away with your profit or accept a small loss. Brian P. Anderson lays out simple, powerful rules to handle entries and exits with discipline, so every trade has structure, not chaos. Start with the entry. Anderson believes in trading breakouts and breakdowns because that's where momentum lives. For a long trade, wait for price to push clearly above a defined resistance level. Not just touch it, but break through with conviction. For a short, look for a clean fall below a solid support line. These levels act like invisible fences. When price breaks them with force, it usually attracts even more traders, pushing the move further in your favor. Volume is your confirmation. A breakout without strong volume is like a car with no fuel. It might roll a few feet but stalls fast. Before jumping in, check if volume surges as price crosses the key level. This tells you the move has real backing, not just random noise. Weak volume means smart traders stay out, so should you. Once you're in, the exit rules protect your profit and sanity. Anderson recommends setting a clear profit target the moment you enter. This target depends on the stock's recent range, volatility, and nearby resistance or support levels from your multi-time frame setup. By having a target in advance, you avoid emotional decisions in the heat of battle. Next comes the trailing stop, a smart tool to let winners run while guarding against sudden reversals. As your trade moves deeper into profit, move your stop up for longs or down for shorts step by step, locking in gains. This keeps you from giving back hard-earned profits if the market turns against you unexpectedly. The stop-loss rule is non-negotiable. Place it right below the breakout point for longs or above the breakdown point for shorts. This tight stop keeps losses small and manageable. If price snaps back past your level, it signals the breakout failed. Cut the trade instantly. Don't hesitate. Don't argue with the chart. Many traders blow up accounts by hoping a loser will magically recover. Anderson's rule: hope is not a strategy. Respect the stop every single time. Consistency is what ties these rules together. Anyone can enter and exit randomly and sometimes win. But professionals win over time because they trust their rules more than their emotions. They don't widen stops in panic or close winners too soon out of fear. Every move is guided by the plan laid out before clicking buy or sell. This mindset does more than protect money. It protects mental energy. When you know your entry and exit are pre-decided, you stop second-guessing yourself. You spend less time glued to the screen, sweating over every tick. You simply watch your plan play out. If it works, you bank profit. If it fails, you lose small and wait for the next clean opportunity. Anderson's core message is simple: never hold and pray. Too many traders freeze when a trade goes wrong, paralyzed by hope that the chart will turn around. Most times, it doesn't. Small losses turn into big ones, and accounts bleed out slowly. A tight stop loss, obeyed every time, is your shield. At the same time, don't strangle your winners. A good trailing stop lets the market decide how much profit you get, not your fear. Some trades will surprise you, running far beyond your initial target. Others will hit your stop and exit cleanly. Both outcomes are victories because you stayed loyal to your system. These entry and exit rules create a foundation of trust between you and your trading plan. There's no room for panic, revenge trading, or guessing. Just clear signals, tight risk control, and calm execution. Stick to them, trade after trade, and watch consistency replace chaos. Lesson 7. Risk management and position sizing. Every trader dreams of big wins, but staying in the game long enough to get them depends on one thing above all: protecting capital. Brian P. Anderson makes it crystal clear. Risk management isn't optional. It's the backbone of trading survival. Without it, even the best setups and smartest strategies crumble under a few bad trades. Anderson teaches that before you think about profit, you must define how much you're willing to lose. The golden rule is simple. Risk only a small, fixed percentage of your total trading account on any single trade, usually no more than 1 to 2%. This limit acts like a safety net. Even if several trades fail back to back, the damage stays small and you live to trade another day. Position sizing ties directly to this risk limit. Many traders overlook this step and end up placing random share sizes. Anderson breaks it down with clarity. Figure out the distance between your entry and your stop-loss level in dollars. Then calculate how many shares you can buy so that if the trade hits the stop, your loss stays within your risk percentage. It's simple math that saves accounts from disaster. For example, suppose you have a $10,000 account and plan to risk 1% per trade. That's $100 maximum loss per position. If your stop loss is $1.50 away from your entry, you can buy up to 200 shares. This means you know the exact dollar loss ahead of time, removing stress and second guessing once the trade is live. Why is this so crucial? Because trading isn't a guarantee. It's a game of probabilities. Even the cleanest breakout can fail. News can hit. Market conditions can shift. No trader, no matter how skilled, has a 100% win rate. Anderson drives this home repeatedly. You don't control the outcome, but you do control the risk. Traders who ignore this truth often face the same painful ending. One big loss wipes out weeks or months of small gains. Or worse, a series of oversized losses destroys the entire account. Then comes the panic, the desperate attempt to double down and recover fast, which usually ends in blowing up completely. Risk management removes this emotional roller coaster. By keeping each loss tiny and predefined, you build steady confidence. One bad trade becomes just a bump in the road, not a crisis. You stop fearing losses because you know they can't cripple you. This mental calmness is a huge edge over other traders who trade recklessly and panic when things go wrong. Proper position sizing also helps you avoid the temptation to overtrade. Many traders pile into massive positions on a whim, betting the house on one sure thing. When it backfires, the hit is devastating. Anderson's position size formula forces discipline. You can't take reckless bets if you always stick to your risk percentage. He reminds readers that protecting capital must be every trader's top goal. Profits come naturally when risk is controlled because your mind stays sharp, your emotions stay balanced, and you have the capital to seize the next good setup. But without capital, you're out, no matter how brilliant your strategy is. Anderson sums it up best. Think like a casino, not a gambler. Casinos never bet the whole vault on one spin of the wheel. They manage odds, size bets carefully, and accept small losses all day because they know the edge works over many plays. A trader should do the same. Every time you place a trade, you are placing a bet. Make it small enough to survive the bad streaks and big enough to grow over time. When risk management and position sizing become habits, they feel boring. And that's exactly how successful trading should feel. Calm, methodical, and protected. By mastering this lesson, you stop swinging for the fences on every trade and start building a career that lasts. In the end, guarding your account is the real edge. Every other skill flows from this unshakable base. Lesson 8, Daily Review and Improvement. Every great trader knows the real growth doesn't happen during the trade. It happens afterward, when you sit down and study what went right and what went wrong. Brian P. Anderson ends his book with a powerful reminder. Reviewing each trade daily is the hidden key that turns experience into true skill. Without review, mistakes repeat themselves. With review, even bad trades become stepping stones toward mastery. Anderson encourages traders to keep a simple yet honest daily journal. After the market closes, take a few minutes to record every trade you placed. Note the stock, your entry and exit prices, the size, the reason for entering, the reason for exiting, and, most importantly, whether you stuck to your plan. Write down exactly what you felt during the trade too. Were you calm, nervous, impulsive, or overconfident? This emotional snapshot reveals patterns you can't see on the chart. One by one, these journal entries become your personalized roadmap. They show which setups work for you most often, which timeframes suit you best, and which conditions cause you to lose focus. Sometimes, you'll spot that certain stocks or sectors repeatedly trap you. Other times, you'll find that you exit winners too soon out of fear, or ignore stops because you panic. Seeing these truths in black and white is humbling, but it's also liberating. Anderson insists that this habit doesn't need to be complicated. You don't need fancy software or huge spreadsheets. A simple notebook, spreadsheet, or trading app is enough. What matters is honesty and consistency. Review the numbers, but more importantly, review yourself. Trading isn't just a technical skill, it's a mental game. By studying your own behavior, you sharpen the edge no indicator can give you: self-control. Over time, this daily reflection builds a feedback loop. Small improvements stack up. Maybe you learn to tighten your stops a little. Maybe you spot that you do better with certain volume levels or avoid choppy price action. Maybe you find that taking a break after a losing trade helps you reset. None of these tweaks come from guessing. They come from studying your own real trades. Anderson reminds every reader that no trader wakes up perfect one day. This journey is about gradual mastery, not overnight success. One day's review might feel pointless, but a month's worth shows clear patterns. A year's worth transforms you from a hobbyist into a disciplined trader with real self-awareness. Equally important is that reviewing protects your mindset. It separates your identity from the result of a single trade. Many new traders feel like winners when they profit and losers when they lose. This emotional roller coaster destroys consistency. A daily review resets that thinking. A good trade is one that followed your rules. Profit or loss doesn't change that truth. In his closing thoughts, Anderson circles back to the main promise of his method. You don't need to trade all day, every day. You just need to trade smartly during that focused 1-hour window, follow your tested rules, manage your risk, and study your actions afterward. This cycle repeats calmly, day after day. The review habit is what turns this simple system into a personal blueprint for steady improvement. You'll still have losing trades, every trader does, but your losses won't break you because you learn from them. You'll still face fear and greed, but you'll recognize these emotions and manage them because your journal shows you how they behave. Anderson's final lesson is a gentle but powerful push to trust the process. Trading well isn't about perfection, it's about patience. Show up every morning prepared. Trade only the best setups, control your risk fiercely, and at the end of the day, be your own best coach. Write it down, read it back, and commit to being just a bit better tomorrow. This discipline doesn't just build better trades, it builds a trader's character. In the long run, that's what makes the 1-hour trade more than just a strategy. It becomes a life-changing habit. I hope this breakdown helps you trade smarter, protect your capital, and win back your time, because trading should fit around your life, not the other way around. If you enjoyed this summary and learned something valuable today, please give this video a big like, share it with your fellow traders, and subscribe to the channel if you haven't already, so you never miss out on more powerful trading insights just like this. Your support really keeps this channel growing and motivates me to bring you even more practical trading wisdom. Thank you so much for watching. Trade safe, stay disciplined, and I'll see you in the next video.